I'm Jain. I'm CEO and founder of ActiveAllocator, which is a digital asset allocation platform. In fact, it is the world's first and only portal that seamlessly integrates traditional, illiquid, and alternative investments within portfolios. Our goal is to help you, the investor, analyze your existing allocation, to help you discover inefficiencies, and to help you create bespoke portfolios in a matter of minutes. Additionally, we also monitor research from Wall Street, from wirehouses, from investment banks, from consulting firms to bring you consensus long-term capital market assumptions, things like expected risk, expected return, and you can use these as inputs to validate your own views using ActiveAllocator. So my feeling for 2018 is a resounding yes for ongoing economic growth. I expect earnings appreciation to continue. I expect low volatility, low inflation, and a very low probability of a recession. And of course, the flip side is threats from terrorism, cyber attacks, rising geopolitical tensions, a contentious domestic politics, rising populism. So I have 5 takeaways and I'm going to expatiate on these with data later. The first is no slowdown in economic growth. The widely held view is that global economic activity will continue to accelerate this year. The second is supportive monetary and fiscal policies of the past will remain. US monetary conditions will still remain relatively easy because of the slow and steady pace of expected Federal Reserve tightening. I think we are going to have 3 interest rate rises this year, and I think we are going to continue to see a lot of boost to growth from the Jobs Act. Recession risk is low, maybe 10% or less if one were to put a number in the United States. And it is favorable monetary and fiscal policies and the absence of imbalances that has substantially reduced the probability of recession the world over. However, this is all about being in the real world, and we still need to be vigilant. So some of the most significant risks are not predictable, including rising polarization in the United States, as I said, growing populism globally, heightened geopolitical tensions, including in the Middle East, US-China relationships, the spread of terrorism, and the increased proliferation of cyber attacks. Having said this, one should still stay invested. My 4th point is the collective impact of these risks is still not sizable enough to undermine the prevalent view that we are in a longer than average US recovery, which is going to further support equity returns. And my 5th point is I would have modest return expectations, and I think a market correction of 5 to 10% is very, very likely, and we've already seen one in January and another in February. So I would expect a moderate risk, well-diversified portfolio to have returns of around 4.5%, 5% in 2018. I am now going to walk you through data that supports this. I have a bunch of charts taken from all over the place that provides some color on what I've just said. So this chart here speaks to improving global growth. Growth has been steady and relatively synchronized without a negative quarter across most key regions. The good news is very few countries are in recession or are expected to go into one. One would expect US growth here to accelerate in the short term, probably 3.5% GDP growth, and that's going to be driven in the short term by tax cuts and spending increases, all of which is going to have a multiplier effect, though perhaps not as much as what we saw in 2009. One would expect modestly higher growth rates in the Eurozone too. And in many emerging economies, but a slowdown in Japan and in China. India is expected to grow at a much faster sustained rate, probably 8% or so this year. So, in the moving from the short term to the medium term, we do have risks from inflation. Unemployment is at its all time low of almost 4.1%. So, any extra money that comes in may bid up wages and subsequently prices. And the other risk is the Fed will increase interest rates to slow the economy. However, that is in the medium term. We don't expect anything like this to happen in 2018. In the long term, one would see less flexibility to confront the next crisis, as well as higher interest payments on government debt. The debt to GDP ratio will rise to 90% over the coming decade with higher debt service costs. And hopefully, government debt won't crowd out private investments with high savings. And if foreign capital comes in, that might be a panacea to this risk of government debt rising and crowding out private sector funding. There is a very low risk of US recession, 10% or so if one was to put a number. The probability of recession is very low. And when the probability of recession is low, the likelihood of positive returns is very high. And the reasons for us expecting low recession seem to lie in a benign monetary policy, the slow and steady pace of Fed tightening will continue in 2018, perhaps with 2 or 3 interest rate hikes, a favorable fiscal policy. One expects the new tax cuts and the Jobs Act to boost real GDP growth. And if you look around, you don't see any major economic imbalances. And if you examine current account balances, which economists have done, residential investment, property prices, debt levels in private and public sector, equity market, the output gap, things seem to be healthy. And structural factors too support longer recoveries and a shallower boom and bust cycle. There are no major sector imbalances too. So there's currently very little dispersion amongst equity sector valuations, something I'll be showing you soon in a chart. Monetary and fiscal policies continue to be supportive, orderly, no disruption. And given forecasts for 2 or 3 orderly interest rate hikes in 2018, one does not expect disruptive Federal Reserve tightening. Also, other central banks are withdrawing accommodation against a backdrop of improving growth, and hopefully, this will be a coordinated move. And the multiplier effect, depending on who you speak to, varies. It ranges from a low of 0 to a high of 2.5, 2.2 times. So tax cuts that primarily affect corporate cash flows can boost GDP growth anywhere from 0 to 40 cents. It depends on what corporates do with that money. Similarly, tax cuts for higher income households have a higher multiplier. Cuts for or not cuts, but new spending and infrastructure will go a long way, and it will have a much higher impact, 2.2, 2.5 times. So these numbers are all over the place, but fiscal policies continue to be supportive of GDP growth. There are no major economic imbalances. Consumer durable spending, US investment as a share of GDP are below their long-term average. This is the long-term average, 25.5, and this is the number now. So one expects more scope for more spending. And debt as a share of GDP in US households too has declined. It's declined also in financial institutions, state, local governments, the aggregate private sector. Household balance sheets are very repaired now. Savings rate is picking up. And of course, the equity market impact has been positive for households. So debt service levels have decreased in the low interest rate environment that we've had. The cost of financing is very low. Of course, one keeps hearing that with rising rates, what impact would that bring? And economists have modeled that this impact is going to be pretty small in the medium term. And one reason for that is most debt is long maturity and it is fixed. This is what I was alluding to, that there are no major equity sector imbalances. We keep hearing about some sectors being overvalued. While that might be true, the data suggests that there is a lot less dispersion among equity sector valuations based on the price to book ratio and on returns on equity. This dispersion is pretty tight. Unlike what happened in March 2000 that we see in this chart before the dot com bubble burst. So there is no sector now that is two or three standard deviations outside what are these dotted lines. And this captures the relationship between price to book and ROE. This is a good sign again. The markets have not been driven by Facebook, Amazon, Netflix, Apple, Google valuations, which make headlines. Now, technology companies did do extremely well. They outperformed by a significant margin in 2017. But even if we take out their respective market shares and reassign those weights back into the rest of the S&P 500, the returns for the S&P 500 would pretty much be consistent 17.5, 19.5%. So there's nothing out of the ordinary here this time. So the role of FANGs is much more muted than is believed. We are definitely not in an equity bubble, and despite US equities outperformance, and this is pretty counterintuitive too, investors have shied away from investing in them, preferring to invest in bonds and emerging market equities. And almost 1.8 trillion has flowed out to other asset classes since 2009. However, the interesting thing is buybacks have more than offset these outflows. Since March 2009, we've had almost 4.5 trillion of buybacks. And now there is this silent period before earnings. And as more and more earnings come in, we need to keep an eye out on the buyback number. While certainly not a new worry, investors are rightly concerned about both the age and valuation levels of this market. The bull market is in its ninth year. We are here. And this is long by historical standards, and valuations are elevated. There's no question about that. Over this period, the S&P 500 has generated remarkable returns, and such strong gains have left valuations in their 10th decile. In another way of thinking, that they've been cheaper at least 90% of the time historically, and subsequent returns from high valuations have been muted in the past. Having said this, it's important to keep in mind the bull market this time around has been underpinned by strong earnings growth, by low inflation, with this low probability of a recession, and valuations have been driven instead by fundamentals, by underlying earnings, by continued economic growth, and now by good government policy. So, which is reassuring for equity investors. Of course, valuations tell us very little about prospective returns over short periods. Valuations are a poor market timing signal. Beginning valuations, and you can see it in some of these charts, in some of these numbers here, tell us very little about potential gains over the following year. They explain maybe around just 7% of their variation historically, but they do a slightly better job of setting return expectations over the coming 7 years to 10 years. One keeps hearing about mean reversion, but mean reversion is not something we can rely on, as this can happen over many, many, many years, sometimes even as long as 10 years. And as you can see here, the penalty for exiting equities prematurely can be sizable. The S&P 500 gained almost 340% after entering its ninth valuation decile in March 1992. So it makes sense to continue to stay invested in equities if one is already in it. Inflation. We've been spared inflation for the last 2 decades, and low and stable inflation has underpinned a structural shift in higher valuation levels. We've been in this regime of low inflation since 96, and the hope is we will remain in this current regime for the foreseeable future, certainly so in 2018. So current S&P 500 valuation multiples are around 57% above long-term median levels in aggregate. However, they are only 19% above the median level of the current low and stable inflation regime. So valuations and inflation go together. The odds favor remaining invested during an expansion, and we are still in an expansionary phase. And the state of the US economy is a key driver of market performance, with high odds of positive returns and low probability of large losses during past non-recessionary periods. In fact, nearly three-fourths of bear markets have occurred only during recessions. So, and as last year reminds us, markets often surprise to the upside. And with only a 10-15% probability of recession this year, the economic backdrop remains favorable for stocks. And given current valuation levels, of course, the odds of pullback sometime this year are elevated. We've already seen a couple of days in January, and today is 8th February, in the first week of February too. And that's what we mean by allowing for market corrections. So we've had some days of very elevated market volatility, and this has made a lot of news over the last 2 weeks. Risk assets have sold off in early February and with drawdowns across most equity benchmarks. But this has been episodic, and it is not driven by anything systemic, which is good news. And I'll come back to this point with a chart that sort of explains why we've had that technical driven drawdown. Interest rates too have risen over the last several months. You look at the timing here, and 10-year government bond yields have increased in a synchronized fashion. However, the January US employment report around this time has led fixed income investors to price in additional Fed hikes, and this has triggered the first leg down in this equity market sell-off that we've had last week. It may also have created the bouts of volatility we've seen in February. In talking about all this, we need to be acutely cognizant that investor sentiment had been extremely bullish. At the start of the year, there were almost 4 times as many bulls as bears, close to an all-time high. And the dollar value of non-dealer US equity futures positions reached post-GFC highs too. Cash balances among retail brokerage accounts are at an all-time low. But still, 8 years of equity gains has started to soften sentiment, and this again may lead to further corrections. So, as I said earlier, one needs to keep in mind that the sell off in the equity markets on some days in February seems to be driven by technical, not fundamental factors. And that's a very important distinction. One reason could be the influence of trend following, short volatility, risk parity strategies, could be a potential driver behind the decline. I don't know. There's a lot of commentary that is out there that suggests this. The S&P 500 breached an important technical level, which may have triggered trend following strategies to reduce long equity exposure. And this likely contributed to a flash crash, sell off, followed by a sharp increase in volatility futures after the market closed. But these factors are technical in nature, they are not fundamental, they are not traceable to any obvious economic or political event, which should give us some comfort. An additional point of comfort is recent economic data over the past 2 months has been strong. Q4 GDP releases that are coming in, and of course, a lot of these are going to be redone. They have confirmed the strength of the ongoing expansion across the G4, the Euro area, Japan, UK, and all four economies are growing at or above trend. Labor markets too have been very strong across the board. Unemployment rates across G4 are at their multi-year lows. But the flip side to this is wage growth remains pretty contained, and because of that, inflation has remained stable, and core inflation measures remain below central bank targets in the US, in the Eurozone, and of course, as always, in Japan. So to sort of summarize, we've seen strong S&P 500 earnings results. We see expanding profit margins. Both reported and blended earnings growth are outpacing sales growth. Higher margins. All of these numbers seem to suggest that one needs to be constructive on equity markets, and all risky assets are pegged out of that. So we don't really see any great asset price mismatch. So what does all of this mean? To conclude, one would expect modest returns across asset classes. Overall, a well-diversified, moderate risk portfolio should provide, let's say, 4.5 to 5% US dollar annual returns. And I'm talking about something that is diversified across 12, 13 asset classes, minimum 5% in each. And remember, you can use ActiveAllocator to analyze your own portfolio. You can find how inefficient your portfolio is. All of the things that we've been speaking about, you can express your own views, your own estimates of expected risk, expected return, so that everything that we've just spoken about can have some meaning, some expression within what you do for your own portfolio or for your clients. Thanks for listening in. Bye-bye.